if you got a gold and silver stock is at 52-week lows when silver's over 30 and gold is over 2,600, maybe that's not a stock you want to buy more of this tax loss season. So this time is a bit different. And that's a good thing. I'm glad to have gains to be protecting rather than losses to be harvesting. So the year-end point would simply be if there's more scare, if I don't know, some apparent good news out of the U.S. knocks gold down to 2,500 or even below, I think that would be a panic moment for a lot of gold's Johnny-come-lately friends. And that could create buying opportunity.
Recent market analysis from precious metals expert Lobo Tigger, founder of Independent Speculator, offers a nuanced perspective on current gold and silver dynamics. His caution against purchasing stocks at 52-week lows, even with gold exceeding $2,600 and silver above $30, reflects a sophisticated understanding of market timing, particularly during the tax loss season. The market has validated these insights, with spot gold reaching $2,658 following U.S. macroeconomic data that weakened the dollar. Meanwhile, silver maintains robust performance despite a slight 0.37% dip to $30 per ounce, having gained 26.7% since the beginning of the year. Market projections support this strength, with silver expected to test all-time highs in 2025, potentially reaching $50 and climbing to $82 by 2030. Gold's outlook appears similarly optimistic, with forecasts suggesting prices will touch $2,700 in 2025 before a modest retreat to $2,680 in 2026. Technical analysis indicates significant support at 2,700 and resistance near 2,800. Tigger's observation that a drop below 2,500 could unsettle newer investors speaks to gold's unique market psychology. The precious metal's enduring role as a safe haven asset continues to attract both institutional and retail investors. Central banks maintain substantial gold reserves to hedge against financial instability, underscoring its importance in risk management. This institutional backing, combined with gold's historical resilience during economic uncertainty, supports Tigger's view that temporary price dips often present strategic buying opportunities for experienced investors. He also highlights a common issue in the gold sector. Investors tend to be disappointed when the gold price is stable at an elevated level instead of rising. Tigger dismisses complaints about the gold-dollar exchange rate, emphasizing that gold mining businesses are in a solid position at current price levels. Before diving deeper into this video, subscribe to our channel and hit the bell icon so you never miss an update. Also, share this video with your friends and anyone who may benefit from it.
So normally this would be a time to think about tax loss selling, but actually with silver, still holding over 30 and gold holding at or near nominal all-time highs, I don't have a lot of tax losses to worry about. And for the better companies, the other side of tax loss season is to look for buying opportunities, right? If I'm bullish, but the market is down, the stock is down, maybe, mid-December, I can get a really great buying opportunity. It's a time to go playing in the market with stink bids. But this year, not so much. If you got a gold and silver stock that is at 52-week lows, when silver's over 30 and gold is over 2,600, maybe that's not a stock you want to buy more of this tax loss season. So this time is a bit different. And that's a good thing. I'm glad to have gains to be protecting rather than losses to be harvesting. So the year-end point would simply be if there's more scare, if some apparent good news out of the U.S. knocks gold down to 2,500 or even below, I think that would be a panic moment for a lot of gold's Johnny-come-lately friends. And that could create buying opportunities. If we saw something like that, I would absolutely be, have a garage sale, sell some blood, whatever necessary to back up the truck and buy some great stocks there. If plus $2,600 gold is all we have to worry about, we got nothing to worry about. The better companies should be making gobs of money. I think that's a technical description that this, the projects, the better projects. I mean, an aggressive gold price assumption in a project these days is 2,000 or 2,050. I don't think I've seen a 2,100 yet. And we're so far above that again, the better projects should be able to advance, the better miners should be making money. And by the way, if you have a gold company that isn't making money, you really need to ask yourself if that's a gold company you want to own. Funny thing about gold pucks, we're only happy when the gold dollar exchange rate is going up. When it's holding at a objectively terrific level, that's not enough. We want it to be going up. So let us dispense with the wailing and gnashing of teeth and pulling of hair. There's nothing wrong with the gold dollar exchange. Well, manipulated or whatever. When I say there's nothing wrong, I mean for the actual business of mining gold, we're at a fine place. And to be going into that, what most, whether red or blue, but most economists think is a highly inflationary agenda going forward, starting from the level we're at now, I think is very bullish for gold.
In a recent analysis, investment expert Lobo Tigger parallels current market conditions and the aftermath of the 2008 global financial crisis. He points to 2010 as a particularly instructive period when economic indicators showed mixed signals of recovery and potential troubles ahead, similar to today's complex market environment. The Great Recession, which officially lasted from December 2007 to June 2009 in the United States, originated from the collapse of the U.S. housing market and the subsequent devaluation of mortgage-backed securities and related derivatives. This downturn quickly evolved into a global crisis, marking the most severe economic contraction since the Great Depression of the 1930s. Experts like David Rosenberg anticipated deflationary pressures from potential recessions during this period. Their concerns proved warranted as the housing market's transition from boom to bust triggered a domino effect throughout the global financial system. Tigger's analysis extends to policy responses, highlighting the crucial roles of both fiscal and monetary interventions. He particularly notes the Federal Reserve's actions and stimulus measures as essential tools that help prevent prolonged deflation and recession. These historical insights provide valuable context for understanding current economic challenges and policy responses. Let's get back to the interview.
Right, what was happening in 2010? We're still dealing with the GFC, right, after 2008. For anybody who's not politically biased, and granted, there are some signs of growth. Hey, money supply is going up like crazy. But, there are ample signs of trouble. If that gets bad to where, we have that, beep moment.
The discussion focuses on current market conditions for gold and silver, emphasizing their strong performance as safe haven assets amid economic uncertainty. Gold has surpassed $2,600 per ounce, and silver remains above $30, with projections suggesting further gains in the coming years. The speaker advises caution when buying stocks at 52-week lows during tax loss selling season, even when metals are performing well. However, temporary price dips could present strategic buying opportunities, especially if gold drops below $2,500. Historical parallels to the 2008 financial crisis and expected fiscal and monetary interventions suggest inflationary pressures will continue to support gold and silver prices. The expert underscores the robust profitability of mining companies at current gold price levels and predicts that inflationary trends will persist into 2025, benefiting precious metals and select industrial commodities.